Between March 16th and March 20th, 2026, the financial markets experienced a violent collapse. The week was defined by high-velocity gap-downs, tearing through established support levels and wiping out months of accumulated gains in a matter of hours. The Nifty 50, a benchmark Indian stock market index tracking 50 of the largest companies, suffered a brutal 931.90-point drawdown. Throughout the 5 sessions, the market endured an extreme 3.91% volatility expansion, creating chaotic trading conditions. This chart captures the weekly price action, and the sheer scale of the structural damage is evident in that single massive red candle at the bottom. During a drop like this, the market frequently produces deceptive intraday V-shape recoveries. A V-shape recovery is a rapid, sharp upward price climb that perfectly mimics a market bottom, creating an overwhelming psychological temptation for traders to buy the dip. Traditional probabilistic neural networks, predictive AI models built to calculate statistical likelihoods rather than follow fixed rules, fail completely in these environments. When their optimistic buy signals are destroyed by the ongoing collapse, these black box models often repaint, erasing their historical errors from the chart to hide the failure. An analytical agentic AI system solves this repainting problem. Instead of relying on a single predictive engine guessing at probabilities, it operates as a governed multi-agent ecosystem. This diagram shows the architectural flow of the system. Probabilistic inputs from specialized neural networks are gathered on the left and then fed directly into a strict constraint-based logic engine in the center. Within this framework, neural networks are entirely stripped of decision-making authority. They are strictly subordinated to act only as advisory agents, suggesting patterns without executing them. The actual decision authority belongs to the Market Context Protocol, or MCP. The MCP is a deterministic gatekeeper, a rule-based filter that actively suppresses aggressive trading signals during periods of high market instability. This architecture enforces a philosophy of epistemic discipline. It strictly prioritizes mathematical truth and verifiable data over speculative optimism. By conducting a day-by-day forensic audit of this system's performance during the massive March 3rd collapse, we can observe exactly how its deterministic workflows processed extreme volatility and neutralized market noise. The forensic audit opens on March 16th. The week initiated with a significant gap down, marking the beginning of severe structural decay across the market. Almost immediately, the market presented violent late-day V-shape recoveries. These sharp upswings successfully tricked standard momentum models into generating false bullish signals. This chart displays the exact intraday price action. Those sharp, green upward spikes on the right represent the deceptive momentum shifts pulling in optimistic buyers. The agentic system completely ignored this momentum. Evaluating the math, it logged 32 strong bear 5-minute bars against only 9 strong bull bars for the session. These evaluations are subject to immutable state logging. This means once a 5-minute interval is evaluated, its state is permanently locked into a vector database and cannot be retroactively changed to make the chart look cleaner. This forensic dashboard displays the results of the post-market RAG operations conducted on March 17th. RAG, or Retrieval Augmented Generation, is an AI framework that grounds its analysis strictly in external, verified databases rather than internal assumptions. The audit proved that out of 31 bullish signals generated during the session, the system calculated an exact 0.00% win rate. The system's behavioral protection directive takes this hard mathematical proof and uses it to actively suppress emotional FOMO in human traders, rendering visual bias based strictly on math. The math proved the long side edge was statistically non-existent. Relying on that data, the system safely closed out the first 2 days of the collapse, maintaining a rigid, protective -9 bearish bias. Moving to March 18th, the market opened with a sharp gap up. For human traders staring at a battered portfolio, this presented a massive temptation to call a market bottom and buy in. The system's defensive response began before the bell rang through pre-market baseline calibration. It executed an A-to-A sequential collaboration to pull historical logs and enforce a rigid -10 strong bearish anchor. A-to-A is an agent-to-agent communication protocol where multiple AI components pass data sequentially to refine a single output. Looking at the intraday chart, midday momentum attempted to override that pre-market anchor. You can see the large green shaded area where the system temporarily mapped the momentum as a +8 strong bullish state. Despite those green indicators, the market context protocol algorithmically discarded the midday optimism. The bullish retracements had sailed to break deterministic structural resistance levels. In this system, structural integrity supersedes momentum. Because resistance held, the system clamped the final verdict to a -8 bearish close, entirely rejecting the gap trap. March 19th marked the absolute peak of the market collapse, characterized by extreme structural decay. This schematic illustrates how the system's neural perception modules visually identify the specific nature of a trap before reacting to it. CNN modules explicitly identified the pattern as a parallel white channel. A CNN is a convolutional neural network, an AI architecture highly effective at recognizing distinct visual patterns in chart data. Based on this recognition, the system enforced a highly defensive -21 strong bearish pre-market bias. As the day progressed, autoencoder agents successfully filtered out the midday sideways noise that presented as false bullish reversals. An autoencoder is a specialized neural network designed to compress data and strip away noise, leaving only the primary mathematical signal. This chart reveals the raw intraday reality of that filtered price action. Stripped of the noise, the sheer downward cascade is highly visible, enveloped entirely in the deep red bearish state indicator. The final tally for the session was definitive. Exactly 47 out of 80 5-minute bars closed in a strong bear state. By accurately identifying the specific gap trap structure and aggressively filtering out intraday noise, the system confirmed a structurally dominant bearish regime, ending the day at an extreme -24 bias. On the final day, March 20th, the system inherited the macro volatility of the week. It anchored a -16 pre-market bias and easily rejected all morning gap up attempts. Once the market closed, the deterministic statistic analyzer initiated the final post-market audit for the entire week. The mathematical breakdown of the week's internal states proves the dominance of the bearish regime. The final counts logged 39.6% strong bearish bars, 20.8% bearish bars, and a suppressed 20.8% strong bullish. Most importantly, that bullish segment yielded another definitive 0% sustained win rate. Applying these precise deterministic rules, a master system officially confirmed a compression phase over the trend. This data table shows the final, unyielding weekly verdict. The system locked in a -14 strong bearish score on the weekly timeframe. In total, the system navigated a 931-point market drop without generating a single repainted error. It closed the week deeply in the red, but highly protected. Zooming out from the specific forensic data of March 2026, there is a broader implication here for financial AI architecture. Financial markets constantly generate a chaotic stream of disorganized probabilities. This architecture filters those volatile inputs into rigid, controlled outputs. Unyielding structural governance creates a definitive edge over probabilistic models, especially during high-velocity price action. Even advanced capabilities like NLP interpretation, which uses natural language processing to parse human text data, and complex agent-to-agent collaborations fall apart under pressure without a rigid gatekeeper to enforce logic. The hierarchy is simple. Opaque, black box advisory models suggest patterns from the bottom up, but they are strictly filtered and blocked by the white box governance layer at the top. This strict filtration prevents retroactive weight mutations within the neural networks, absolutely guaranteeing non-repainting market integrity. For the human operator, this translates directly into mathematically backed UI guardrails. When the system proves the long-side win rate is 0, it strips away the psychological urge to engage in emotional panic trading. By enforcing structural discipline, the system maps market volatility to an auditable, protective mathematical truth.